Global markets are in a state of high-velocity churn. Billions of dollars in capital are exiting emerging economies at a rapid pace. The driver is the U.S. Federal Reserve. Rising interest rates are pulling foreign portfolio investors back toward the U.S., causing inflows into Indian government securities to stop. This data confirms the drying up of that specific capital stream. This level of foreign departure typically creates extreme volatility, yet the Indian market has remained remarkably stable. Retail investors and domestic institutional investors are the reason. They are absorbing the sell-offs, and as this report indicates, retail ownership of the domestic market has reached historic highs. Increased domestic ownership reduces the overall panic risk. The market is less susceptible to sudden swings dictated by interest rate cycles in Washington or London. India is developing a financial firewall, creating a growth baseline that is increasingly resilient to external monetary shocks. With the financial markets stabilized, we can track where the large-scale capital is actually settling. It is flowing out of liquid assets and into hard physical infrastructure. This deal between Alpha Alternatives and 𝐄𝐂𝐎𝐍𝐈𝐂 is the benchmark. Alpha Alt is acquiring 4 operational road assets for 7,500 crore rupees. This map illustrates why these assets are attractive. Infrastructure provides predictable cash flows through tolls. For large-scale funds, this locks in capital for decades. Developers take this cash to fund greenfield projects, effectively recycling capital to build the national network. These massive buyouts physically anchor wealth, providing a highly stable, high-yield foundation that fundamentally supports the broader national economy. While domestic wealth anchors infrastructure, aggressive global capital is still entering the market to target a completely different kind of asset, localized artificial intelligence. 𝐓𝐈𝐿 is the current focal point. They are raising $75 million from a group led by NVIDIA, bringing the company's valuation to $1.5 billion. NVIDIA's involvement points to a strategic gap. India requires AI models built specifically for domestic enterprise and government datasets, which differ significantly from the generic global models. This flowchart shows how that capital translates into utility. It moves from hardware into a localized model, which then branches out into dozens of specialized domestic applications. This is forcing the IT sector to move toward high-value, outcome-based pricing. Global capital is rapidly concentrating in these strategic technological layers, seeking the high yields associated with localized disruption. We see this same maturation in the startup ecosystem. The focus has moved from aggressive customer acquisition at any cost to the reality of unit economics. Ether Energy's Q1 results offer the strongest evidence of this shift. Their revenue doubled, while their operational losses dropped by 71%. This chart compares the two metrics. The rising bars show revenue growth, while the declining line shows a sharp reduction in burn. They're scaling efficiently. This financial turn suggests major EV players are moving from proof of concept towards sustainable long-term operations. Capital is now flowing toward the startups that can prove actual business viability in a tighter interest rate environment. These macroeconomic shifts eventually translate into a different kind of balance sheet, the return on human capital. The medal tally from the Commonwealth Games provides a useful metric. India's success is diversifying, with medals coming from judo, boxing, and parasports. This success across many disciplines creates what experts call a depth dividend. In both sports and markets, this kind of depth serves as a hedge. A diversified base makes the entire system less vulnerable to the failure of any single component. That resilience is visible in the strength of retail investors, the anchoring of infrastructure assets, the pivot toward strategic AI, and the focus on startup profitability. Subscribe to TradeX as we continue to follow the capital. Let us know which of these engines you think will drive the most growth in the next 5 years. Global markets will remain in flux, but India is building internal economic engines designed for the long term.